great to have such a turnout today. Want to welcome everybody to our panel on investment opportunities. In getting prepared for today's session, I had an opportunity to compare notes with my wife, who's an attorney at the Federal Trade Commission, and she happened to be preparing for her own hearings on competition. And I mentioned to her how great a panel we have today, and she responded by telling me that she had 4 state attorney generals coming to her hearings. So I'm not sure that I impressed her, but we both agreed that whether you're talking about finding deals or clearing deals, it's all about the panelists. And we have a great group here today. I have a lot of questions for our session, so we're going to go ahead and get started. Our topic is finding hidden treasures in real estate and REITs, which are really 2 completely different missions. And first, we're going to talk about direct investment in real estate. And as the real estate markets have become more and more competitive, how do you find the great opportunities? Does it require greater risk to try to achieve the same target return? Nelson?
Thanks, Stuart. Well, every market's a bit different. It's certainly, New York is certainly a very competitive market and has been for many years, but things are shifting and changing a little bit on the capital front. So our company is focused exclusively in office, and we're primarily in Manhattan, San Francisco, and DC. And those 3 markets are very different. San Francisco's hotter than ever, very competitive on the capital front, and of course that matches great leasing fundamentals. Great supply-demand imbalance, which in the landlord's favor these days. So we've been trying very hard. We haven't bought anything there in a few years, but it's a very tough, tight market. DC, on the other hand, has had softer fundamentals, a lot of new supply, decent demand, a lot of new supply. Still plenty of capital coming to DC, which makes it still very competitive, but not quite as attractive a market to us. New York is somewhere in the middle of those 2. A lot of new supply, particularly on the west side and downtown, but still very strong demand. I'd say on the capital front, though, in terms of competing for acquisitions, certain sources of capital, a lot of international capital has pulled back in recent years, at least compared to where it was a few years. So at least on the larger core stabilized type properties, we think maybe there's a little more room there to compete for properties. But on the value add front, which is the last couple of deals we've done have been development and value add, that seems to be as strong as ever. Everybody's looking for juice or ways to produce returns, and yes, that of course requires more risk and discipline. But I'd say it's as competitive as ever. Maybe different sources of capital, maybe not quite as deep competing in New York as there was a couple of years ago, but still incredibly strong. It requires a lot of discipline, patience, creativity. So as a consequence, we only do a couple deals a year, and that's after looking at dozens and dozens.
Great. Marguerite?
So I'm in the business of manufactured housing and RV parks, and there is really no new supply in that business. And so it boils down to relationships and building those relationships with the owners to be there when they want to transact. There's life events that happen that cause a transaction to become kind of top of mind for them. But it's difficult to know when that would happen and when that would occur. So that's why there are few transactions in our space. But we have found it to be more and more competitive over the last few years. And those relationships that we've built up over the years have been helpful to us getting the transactions. But I think that as we look to, what are the risks that we're taking? Certainly, there's lower cap rates associated with it, and it's really at that point that we make the decision as to whether or not it's something we would pursue, or whether or not we would continue, as we have in many cases, to say we're not going to do a transaction because of our disciplined approach, and that it doesn't make sense in some cases.
Nelson, how are you looking at cap rates in your sector currently?
Well, we transitioned the portfolio. We took over a portfolio years ago that was largely suburban, spread across 30 different suburban markets. So these were high cap rate type properties. We chose, for long-term strategic purposes, we chose to sell those and reinvest in low cap rate environments like the 3 markets I mentioned. Cap rates, most of the properties we buy on a stabilized basis are in the 5 cap or less. Again, it's CBD, New York, San Francisco type properties. I don't think there's a lot of talk about whether or not cap rates are rising. I mentioned earlier certain capital sources have pulled back. But for quality, well-located property, there's not, to us, we're not seeing a strong indication that prices are dropping, that cap rates are increasing. It's still very, very competitive. But it varies very much by neighborhood, by quality of the property, et cetera. But you know, perhaps if I had to say are cap rates expanding or tightening, I would lean toward expanding, but there's no evidence that it's been anything dramatic in our world.
Great. So next, we want to talk a little bit about how you actually find the opportunities. Of all the opportunities that are presented through traditional methods, established broker networks, how many of those do you find interesting enough to actually investigate? And are there other means that you're using, and how much has that changed in the last few years?
You know, what we do is we look around the assets we already own and really get an understanding of what opportunities there are right there. There may be vacant land, there may be an adjacent parcel that is a manufactured home community or an RV park that is not the top tier asset, but when put together with our existing asset, that is interesting. So we will look to that. So we'll look to areas around the properties we own. We have a broker network that we use extensively across the United States. I think brokers are important. Obviously, you can't rely on them for everything, but certainly having more people out there expressing to owners who aren't quite ready yet and aren't quite at the point where our internal teams, it makes sense to spend time with them. It may be a 2 or 3 year process. So I think we spend time, the brokers spend time for us on the longer term deals, and then internally we focus on the deals that are more imminently closing.
Okay. Nelson, what's your experience?
Yeah, I agree with that. Investment sales brokers are a key part of the process, and it's very rare to find a deal or an opportunity that's off market. Maybe it's not listed yet, maybe they haven't signed up a particular broker, but at least in our sector, the market knows about it, including most of the investment sales teams. And they're always involved, almost always involved at some point, a very key part of the process. But I agree with Marguerite, it's key to know what you want and to be disciplined and not get distracted with every deal that comes across your email or every pitch book that shows up in the mail, and stay focused on what you're looking for, and also principal to principal, company to company conversations are always important. In knowing your neighborhoods, knowing your markets, knowing what's out there, including your own portfolio, and looking for opportunities within the portfolio, as Marguerite said. So, again, most properties are marketed or brokered, even the ones that aren't technically. Investment sales team's never very far away.
So one of the themes that we've heard throughout the day so far is use of technology. How much has that impacted ability to find opportunities, online sites, auction.com, et cetera? Marguerite?
So I started out at ELS 25 years ago in the acquisitions department, and it was fly out and look around, and hopefully you can find some assets and get the yellow pages out. And I see our acquisitions team now and doing what they can do with the data in front of them. And it's absolutely amazing to me comparing the two different ways to look at things. So certainly that allows us to go through a process a lot quicker where we can eliminate opportunities. And we said that's not something we want to do. And then we kind of put another bucket of this is something we need to pursue more. So that's on just the kind of the due diligence in the underwriting to kind of begin with. We've also used auction.com and have been successful in buying a couple of RV parks a few years ago. And it was a pretty exciting thing for us because we had never done it before, and you just, the desire to keep wanting to press the button, to keep raising the prices is something that we had to have that discipline where we had this is the level we're gonna stop at, we're not gonna go any further. But it was pretty neat to be able to encapsulate everything all at once and be able to know that you were gonna own that asset. I thought it was a pretty neat process.
Great. In looking for new opportunities, how much time do you spend looking at the new frontier of asset classes? Some are clearly real estate, others are more established, everything ranging from single-family home rentals to cell towers to marinas to timber. Do you consider all of those real estate, and where are the best opportunities today? Andy?
So when we think about different opportunities that are kind of away from the 4 or 5 main food groups of real estate, we think about, is this business scalable? Is it financeable? And is it liquidity? Because if you can't hit those 3 parameters, the clients who we're dealing with, like KKR and others, they're going to have no interest. So we think about it in those terms. And if you can get past those 3 metrics, then it becomes more interesting. So when you think about things like data centers, it took a long time for that to get scalable, and then it took a while to get more people interested. And now when you think about how you could finance it, there used to be only one way to finance it. Now you can CMBS finance data centers, you can ABS finance them. So there are lots of different asset classes. Some of them take time. Hard to believe that manufactured housing wasn't part of that main food group, and over time it has become kind of that key food group, probably better performing than apartments or any other asset class. So it's trying to figure out what those asset classes are that you can really put out large amounts of capital in. And so we do spend time thinking about farms and vineyards and theaters and marinas and other asset classes. Some of them fit and some of them don't fit.
Marguerite?
I think we concentrate a lot on what the customers are doing. So we'll look at what our customers are interested in. And we've certainly looked at, that's really how we got involved in the RV space. In the beginning, 14, 15 years ago, we were strictly a manufactured home community owner. And we looked at where are the opportunities that have the same cash flow characteristics as what we love, which was the manufactured home business. And we then started into the RV business. And we also noticed that our customers, our manufactured home customers, owned RVs. So we were really looking there. We were looking at our customer base and seeing what they were doing. The same as we have gotten into the marina space. We know we own marinas before we got into a joint venture. We know that our customers are interested in that space. We've also looked at, does self-storage make sense? Are there other areas that make sense for us? Really following what the customer is looking at and what our customer, which is that 55-plus customer, is looking for.
And I think the public markets have appreciated that you've taken that, both the approach to the cash flow as well as to your core strengths. Because when we underwrite a company, one, that core strength is obviously a key factor, but also the contractual long-term obligation is what is really meaningful to being able to underwrite, a long-term growth scenario.
Right, and I think those cash flow characteristics are really important to us. And if we could find another industry that has those same cash flow characteristics, we'd be very interested in it.
And Andy, going back to something you said earlier in terms of the different asset classes, is it a matter of being creative to look at assets classes in a new way to see if they fit the parameters that you described, or is it also a matter of how technology is impacting different asset classes? For example, I think data centers is pretty well understood. I think in the single-family home rental business, the use of technology is making it possible for that asset class in a way that has become very prevalent recently. What are your thoughts there?
So I think people, they look at real estate and they look at it as a set of cash flows. And so it's really cash flows and what's my risk to those cash flows. And so I think if it's coming from manufactured housing or it's coming from data centers, I think real estate people mostly evaluate it the same way, trying to understand what's the certainty and what's the risk. And that's why I think we're finding people who are looking for opportunities that have gotten away from those 4 or 5 main food groups, because those are the easy ones to understand. There's probably more risk in some of the other ones, but probably more upside. But again, I think it goes to, can I really scale those opportunities? Do I want to spend my time on a $50 million asset where if I can't scale it, no matter how good it is, it doesn't really do me any good because it's a one-off transaction.
Great. So now we're going to shift gears and talk more about investing in REITs. As everyone knows, the RMZ has recovered nicely in the first quarter of this year after the big sell-off in December, and I think through yesterday's close, was actually up about 4% above the pre-sell-off levels in December. But when you're looking at investing in particular REITs, you need to consider individual asset classes, and where do you see the greatest opportunities currently in investing in REITs?
Well, I live in a relative world, right? So for me, most of my clients hire me to beat the benchmark. And to beat the benchmark, one of the most consistent ways for me to do that is to pick the best stocks within each sector. So I don't tend to take large over or underweights on a sector basis. I will, to reflect fundamentals, but I always have to overlay public market valuations on private market fundamentals. And so as long as I can identify those individual stocks that are going to outperform their peer group, I buy those. Now, I do have some sectors where obviously, and I think if you surveyed this room, most people would agree that industrial, data centers, towers, single-family residential, and manufactured homes all have very good fundamentals, but it's at what price? And I think Andy's right, risk always is a factor, and that's part of how we value the companies, is the risk to the cash flows. You have to take that public company valuation into consideration whenever you're valuing those real estate fundamentals.
Right. Billy?
Well, it's anytime you have as much momentum as you've had in a couple of sectors that were just mentioned, so all things residential and logistics, there's that voice that comes up saying if everyone believes to such a degree, it can't be true. But when you look at the data and the fundamentals, it's hard to beat them or deny it. And I think there's a reason why you've seen over the last decade so much continuing momentum in a few sectors. And some of that is we're at a period of these interesting and severe disruptive trends that when they come, maybe they take a little bit longer than you expect, but when they come, they're much more severe and much more all-encompassing than you ever thought. And they're continuing. So whether that's the e-commerce trend that's impacting retail and logistics, or whether it's some of the preference and consumer finance trends impacting housing choices, those are well known, they're upon us, but they're continuing. And so we are continuing ourselves to invest behind those trends and continue to like those sectors in spite of what are some pretty heady prices. And then the way we try to invest behind them, given that dynamic, is to try to find things that can turn into the perfect check-the-box, digestible output that then for which there is endless capital demand in today's world. Please go ahead.
I was just going to say, one of the nice things about the public market is we have lots of investors, generalists, that invest in themes rather than fundamentals. And when they do that, whether that's by sector or by company, it often causes the public company prices to diverge from the fundamentals. And that's an opportunity for us, right? Because what we want to do is buy on real estate fundamentals, because ultimately the stocks are going to trade there. And so if they diverge from that fundamental, that's an opportunity to create alpha. And I think it's because of the liquidity in the public market, it's an extra tool that we have to generate alpha that's harder to do when you're buying direct assets.
So in looking at finding those opportunities where there's the pricing difference in the REIT space, given your jobs, how do you compare what you need to do in the REIT space to others who are outside in other industry sectors? Do you think it's harder to find those opportunities or easier in the REIT space compared to other sectors?
For my business, I think actually the real estate public market is less efficient than the general broader equity market. And I think that for real estate dedicated investors that take the time to understand the local fundamentals, it does represent an opportunity. And I think that's evidenced by when you look at the number of REIT managers that outperform their index, it averages about 60 to 80%, depending upon the time frame, relative to S&P managers that outperform their indices about 35% of the time. So that statistic alone tells me that we have more inefficiency in our market and more opportunity to buy when the fundamentals diverge from the public market pricing.
Great.
I agree with that. I mean, I think there is, as Sherry said, this relationship where you have a very liquid and deep private market for the disaggregation of the company that then trades publicly. That's a fairly unique attribute to real estate. Obviously, there's some other hard asset classes that are similar, but few to the same degree of real estate. So it adds another tool in the toolkit, particularly if you're straddling the public and private markets and have the ability to invest in public markets, but also to exert control to try to realize some of that as well over time.
So for sectors that are currently out of favor, but you have a particular REIT where you believe in the management team, how do you look at that opportunity? Are you still willing to consider opportunities like that, or is it so sector-focused that opportunity is not something that you would look at?
Oh, we absolutely look at it. And I think really that's a huge opportunity, whether you're talking about out of favor sectors like retail. You know, if you have a company that has three components: one, assets and good locations; two, a management team that has a strategic vision; and three, and this is very important, the capital to invest in the properties to position them for the future. And that really relies on the management's vision to know what that future is and to invest that capital wisely.
Okay. And Billy?
Yeah, agreed. I mean, if you look at, you know, one of the more interesting sectors today along that front is in the healthcare real estate side, where there is massive divergence amongst individual owners in terms of fundamental performance, and then equally massive divergence in terms of valuations, where some are trading at all-time highs and others are crashing through the bottom of their all-time lows, and oftentimes for good reasons, but sometimes in head-scratching ways. And so we certainly are looking for those opportunities, and particularly a couple of the tweener sectors. I mean, if you took the sectors of real estate today and you put all things housing and logistics on the golden side, and retail on the other side, things like healthcare or office. Nelson talked a little bit about the different fundamentals across his markets. I mean, within office, there are a lot of different stripes there, and so finding the right teams, the right portfolios that are well positioned within some of these markets that have some bright spots and some dark spots is where it gets most interesting for people like us.
Great. So who has it right between the private sector and the public market in valuing real estate and REITs? Andy?
Well, I'd say today they've seemed to have, converged, right? If you go back to December, for no apparent reason, private markets went down, 15-ish%. Nothing happened with the value of the real estate. Public markets trades a lot based on what's happening with the 10-year Treasury. And now you've got a 10-year Treasury that's sitting, sub 2.5%. That's going to be a nice valuation bump for the public REITs. But, again, today you're kind of at equilibrium. I think we go through periods of time. There's so many extra factors that impact how stocks trade that don't impact what's happening in the private markets. And so, with that, you also get the ability to have liquidity at any point in time. But I think we're going through periods where you see REITs that are trading at 85% discount to NAV, and you've got some sectors that are trading at 120 or 130%. And then when you look at some of the individual sectors, you'll see, you've got cap rates on some mall assets that are at 11 cap rates, and then you've got Taubman and Simon that are trading at 5.8% cap rates. So obviously big differences in quality of assets, but you've got huge spreads and huge views on how public companies trade vis-a-vis what's going on in the private markets.
Billy, how do you look at the differences that we've observed in the last several months and in the longer term?
Yeah, well, I guess one thing we can say that this question is it's a fun speculation, right? The one thing we can say maybe factually looking back is the private markets have probably had it more right over the last 5 years. The public markets have had hair trigger on rates and on this anticipation of this looming downturn, which I'm sympathetic to. I think many of us have had that anticipation, but obviously hasn't proven out. And so, whereas the private markets have been chugging along and capital has built and yields have compressed and real estate values have increased relatively gradually or directionally in the same direction. So that's one comment. The other comment I think you have to take into account is I'm not sure always that some of the advertised NAV discounts or premiums really reflect what they're supposed to reflect, right? Which is, in theory, the private market NAV is supposed to be what you could sell those assets for if you went to, in an orderly way, liquidate. And that's not just a commentary on the sell-side analyst community at all. I think that's, if you look at private real estate owners, we find that 9 times out of 10, anyone who owns retail and call it legacy office, so legacy being kind of some of the legacy corridors that were perceived as premier 5-10 years ago, almost invariably has their books overmarked. And it's just there's a latency in some of that mark to market. And so what might appear on a page, and then conversely on the industrial side, where oftentimes it looks like REITs may trade at a premium, I'm not so sure you couldn't get a premium to that if you really went and marketed some of these assets in the private market. So I think there's maybe there's a little bit of, given the severe tectonic shifts that have happened in some of these sectors, there's a little bit of a catch-up game there as well. But one of these days, the public market's going to have it right in terms of anticipating the looming downturn.
Great. So what's happening in retail? It's been a troubled sector for a while. Is now the time for consolidation? Andy, how do you look at that sector?
So I think, you've got huge disparities in, if you kind of separate out the shopping centers from the malls. So you look at the mall sector, you've got, companies that seem to be in severe trouble. They're trading at double-digit cap rates. And then you've got Simon and Taubman that are trading not at historically low cap rates, but kind of in that mid to high 5% cap rates. And if you look over long periods of time, taking out a few very high peaks, malls have traded around a 5% cap rate for 25 years. But there's huge discrepancy in the A quality malls, and that's what people want, and then B and C, where people think there's absolutely nothing that you'll ever be able to do with them. When you go to the shopping center side, again, you've got Federal that trades at a 21 or so, 22 times multiple, and according to research analysts, is trading at a huge premium. And then you've got kind of some of the low quality retailers who are trading, analysts have them at 30 to 35% discounts. And the question is, where is that middle road? Where is someone willing to take a bet on shopping centers? Because when you talk to some private operators on shopping centers, they feel a lot better about the sector than the public markets do. And I think, we're slowly beginning to see people who were totally afraid of getting into the shopping center sector now, quietly saying, maybe I should be buying, maybe I should be thinking about it. I think their view is the public markets just have it wrong, and I think there's some good buying opportunities. I'm not sure we're going to see public-to-public merger deals. I think that's too hard for public companies to get their arms around today. I think going out and buying another shopping center business, if you're public, I think investors and analysts would kind of view that as, gosh, you're probably buying more trouble, and why do that?
And so for particularly focused on the B malls, can you comment a little bit on the redevelopment of those properties and appetite for that, and whether that would lead to take private opportunities where you have someone with the right platform who could undertake that?
The issue becomes is how much capital do I need to put in to re-tenant and redevelop? And can I buy malls at the right cap rate today that allow me to do that? So I think that's more of a private owner, private developer who have that expertise going and buying from a REIT who can say, gosh, I sold it at a certain level. I may be trading at a 9 cap, but it was accretive for me to sell that. I think, again, the public company's going to do that. I think they're going to stay away from doing it. But as a private investor, if you see that opportunity that you could either totally re-tenant and knowing that you're going to have to put a certain amount of capital in and make the returns. But again, it's in today's market, that's a higher risk assessment. And I think if you ask most, and I'd be interested in what Billy would have to say, is it worth the risk? Would my investors rather see me go out and buy industrial or apartments, or should I take a risk and go buy a few $billion-dollar retail company? And how would people think about that? Didn't mean to put you on the spot. But.
Oh, that's all right. That's all right. We own a couple of malls and have lived this experience over the last couple of years. I think our general conclusion, and coming back to when everyone's sure of something, you got to question whether it's got to be wrong. So we're constantly asking ourselves to reevaluate that. But it's been hard for us to find something of scale in the retail space where you say the equation you just said makes sense, where the capital required to reposition along with the rewards of that on a risk-adjusted basis makes a heck of a lot of sense. I think if you were out there trying to do it on a one-off basis, there are certainly examples of that, and I'm guessing that they're going to be more and more successful, small, with a lot of sweat equity to go create that. But in scale, we haven't seen that crossover where the economics there make sense.
Well, and part of that is just the sheer amount of retail space that the U.S. has. We just have way too much of this stuff. And so finding the the individual jewels that have the right demographics, that don't require inordinate amounts of capital to position them, and have all of those characteristics that allow it to attract a tenant base that more and more is indifferent to format. I mean, more retailers don't care whether they're in a shopping center, a power center, or a mall. I mean, think about all the crossover that you see. They are really indifferent. What they want is access to demographics. And so I have no doubt that there's plenty of shopping centers out there that could be repositioned and be successful, but I'm not surprised that you can't find them in scale, because there's so much other that it just needs to go away. We have something like 5 or 6 times the amount of retail that Europe has. And so I can't imagine that we really need to buy 5 or 6 times the amount of products that our European colleagues buy. So,
Yeah, I mean, look, the sentiment has been so negative. I think people are nervous about making that big bet. And aside from, the economics of it, is now the time to do it? Or the view over the last 2 or 3 years has been, let me just wait. Let me wait a little bit longer and see what happens. And people have kind of been waiting. And the question is, are they going to continue with that thesis and wait until things get really, really cheap, and then they can take the risk of buying in probably what is a over-retailed environment?
So given with what you just shared, unlikely to see much activity in the remainder of 19?
I think it's hard to think that we're going to see a lot of public-to-public REIT merger deals or a lot of take privates. That doesn't mean there won't be some that happen, but I think when in our discussions with people who are looking to take risk and where they're going to take risk, they're still somewhat skittish about retail.
Great. So next, we're going to talk about the office sector and the recently announced signing of a merger agreement between Cousins and Tier. Nelson, what were your thoughts and reactions to that deal?
So from the outside looking in, I'm familiar with both companies and their leadership, but not the deal itself. But Tier is relatively small, and they're both in the same Sunbelt markets. Cousins has quite a history in Austin, successful history there. So it seemed to be a great symbiotic fit. I can't speak to the economics of who got the better deal or that part of it, but from a consolidation of the companies and the cultures and the portfolio, it seemed to make sense, and it was a reasonably bite-sized deal.
Okay, great. Andy, what were your thoughts?
No, I'd agree. I mean, it seemed very rational. They very successfully bought Parkway a few years prior to, so they had a good track record of buying assets. I think Nelson's comment about having greater influence and access in Austin was probably one of the most important parts of the deal, and it gave them that. Hard to make these deals very accretive, but it seemed the market seemed to like what they did and have a lot of trust in the management team.
Okay. And so how do you look at the deal for the sector as a whole? Do you think that deal can spur more consolidation activity, or is that a deal that just on its own made sense but doesn't lead to other activity?
Well, whether that deal, this topic has been front of mind in our sector, in the office sector, for many years. We listed our company just over 5 years ago, and we and just about everybody else in our sector has traded at discounts to our underlying asset value since then, for a lot of reasons. Concerns about direction of the economy, interest rates, job growth, densification within office. There's been some concerns in our sector, and that's been magnified in the office owners in the gateway markets, relative to the value that you have to pay for those properties. So for a lot of reasons mentioned before, REITs have traded well off, office REITs, gateway office REITs have traded well off the NAV. So with our investor conversations in our boardroom, it's a regular topic. One of the primary reasons you are a public REIT is have access to public capital, but you can't really feasibly raise capital by issuing new shares at those kinds of discounts. Markets do cycle, and we do, like all of our peers, we do everything we can to erase that discount and grow value, grow underlying value, and grow cash flows. Our strategy, we think, is working because on a relative performance basis, we've done quite well in the last few years, but it's something you've got to think about. And I'm sure all of our peers are talking about it and thinking about it. Now, if you look at that, how do we grab that discount? How do we capture that higher private price for our shareholders? It's easier said than done, right? Could be an expensive proposition, transaction cost, of selling, converting, unwinding debt, paying lawyers and bankers and so forth. So it's not as easy as just converting it. And then also, more importantly, you've got to match capital with what you have to sell. We've sold an asset a year and a half ago for a 4.1 cap. It was a 30-year bond with great credit. That's a great price, right? That buyer is not buying a company. They're not buying a value-add deal. You'd have buyers who would very much love our San Francisco portfolio, and maybe they're not as keen on New York, and maybe they're even softer on D.C. But there's another potential buyer that wants D.C. but doesn't want San Fran. So there are a lot of ways. It's not as simple as just saying, even if the NAV is real, and I agree with Billy that I think, not ours, of course, but I think some are a bit inflated out there. But even if you trust that NAV is reasonably accurate, going and capturing that is easier said than done.
Andy, what are your thoughts on the Cousins deal and impact in the sector? How do you look at that?
I don't think their transaction necessarily spurs others to do things. It's not, there's not a size issue that companies are too small. They got to go out and merge to get out of the situation that they're in. I think it stands on its own. Will we see other merger deals? I think there are always deals that make sense from an economic perspective, but do they make sense to the boards, the CEOs want to do them in today's environment? Do they think they can create more value on their own as opposed to merging with someone else? How will the market see it? What are the costs? Can they get financed? Are there other alternatives? Are there cash buys? So I think those are all the things that people take into consideration when they think about these merger transactions. But this on its own won't necessarily make others do anything.
Great, thanks. To what extent is activism today impacting investment opportunities? Sherry?
I think activism, I'd say 5 to 6 years ago, picked up in the REIT space and has continued to be a meaningful part of our world. How it impacts our investment opportunities, it's hard to predict, and so it's not something I would have an investment thesis around. My worry about it often is that it can waste tremendous management resources, sometimes without any real reason or purpose or ultimate goal. And in addition to the waste of resources, sometimes it causes a reaction that is premature and doesn't fully realize the value potential of a company. So that's the negative side. On the positive side, it has made some of our companies with poor governance structures or poor management teams actually move to correct things. Yes, they corrected them. Did they achieve full value? I don't think that's always the case. At BlackRock, we prefer to engage with the management teams and try and bring about change that way, rather than do something in a more public kind of antagonistic way. Both are viable for actually achieving change, but that's just the way that BlackRock as a long-term investor approaches it. I think the best defense against an activist is to actually, for management teams to do their job. I've said this before. If you do your job, if you have a long-term strategic plan, if you act on that plan, and you won't have activists in your stock, particularly if you do a good job of communicating that to your shareholders.
Great. Andy, how do you look at activism in the REIT space over the last couple of years and looking ahead?
So I think Sherry made the right point is, if management teams are doing what they're supposed to be doing, if boards are set up the right way, if there's, shareholder first views, I think, companies, won't see that. And I agree that a lot of times we see activists come into the company stock, and it's an incredible time drain. There's costs, there's lawyers' fees, and there's just lack of focus on your existing business and having to focus on, the activism. Look, we're seeing more of it. Sometimes it's healthy. Sometimes it points out issues, either, from a board or management that need to be addressed. and I think we'll continue to see it, as we go forward. Right now there are a few people who do it in the space, but over time, my guess is we'll see more and more of it.
Great. So going back to the beginning of our discussion and making the distinction between direct investment in real estate versus investment in REITs, who do you think has the harder job in finding the opportunities now? Marguerite?
I think, I'm not sure who has the harder job, but I think when I think about the role that we have at ELS and focused on our customer base, we have 140,000 sites, 1 million plus customers. It allows us access to a lot of information that allows us to then kind of consider what opportunities there are. That being said, I think that's information inside of our customer base. I think there's a lot wider net, like at BlackRock, for instance, that I'm sure Sherry has access to, that could cast the net a lot wider.
For us, again, it's always about, getting the best relative company and outperforming the index. So that opportunity is always there. I certainly think there's more competition for assets in the private market, and that has its own challenges. The challenge for us as investors really has been the negative funds flows to the sector, and if you look at the ETFs or the Japanese funds or the mutual fund flows, they've been negative for several years. And so that creates challenges for dedicated investors, and also just for the space in general, because we're no longer the marginal buyer. And that being that marginal buyer for someone who really understands the assets is a very powerful momentum for the stocks. And so we haven't had that advantage. But nonetheless, I do think the alpha opportunities have still been there. So for our existing clients, we've certainly been able to invest the money and invest it and gain alpha.
Okay, great. Do we have time for questions from the audience? Anybody's got a question, if they can go up to the mics in the center of the room. Okay. All right, well, if not, great job, panelists. Thank you.